While everyone is loading up on AI stocks and meme plays for 2026, I'm doing the exact opposite. This month, I just moved most of my money into my TFSA and I'm buying 5 stocks that many people might find boring. But here's what most people aren't paying attention to. 3 of these stocks are already up more than 20% this year, and one of them has increased its profit margins by 1,000% over the last 3 years. Yes, 1,000%. If you're still chasing the next Tesla or Nvidia, you might want to stick around for the next few minutes, because strategies that worked in the last cycle don't always survive the next one. Let me show you what I'm seeing. I'm Alex. I hold about 70% of my portfolio in US stocks. If you're new here, welcome. I analyze the US stock market from a Canadian perspective, focusing on what Canadian investors care about most. Here's the situation I'm watching right now. As we head into 2026, I'm seeing retail investors repeat the same mistakes they made back in late 2021. Everyone is chasing growth stories, momentum trades, and the "this time is different" narrative. And to be fair, this approach worked incredibly well for a while. But once volatility starts picking up, the playbook usually changes from trading through multiple market cycles. One thing shows up again and again. Institutional money doesn't rotate into the next hot idea. It rotates back to fundamentals, cash flow, profitability, companies that actually generate real money. This is especially important for Canadian investors because the TFSA is now a 100K plus powerhouse, arguably the best tax shelter in North America. Every dollar of gains is 100% tax-free, but this advantage is wasted if you don't hold the right assets. To truly optimize it in 2026, you need a 2-pronged strategy holding high-quality Canadian blue chips to capture tax-free dividends and non-dividend paying US growth stocks to avoid the 15% IRS withholding tax while keeping all the capital gains. Today, I'm walking you through the 5 stocks I'm personally buying this month and the 2 overlooked metrics I use to pick them. Before I get into the stocks, the framework matters. I focus on 2 things, and only 2 things. The first is operating cash flow growth, not revenue growth, not adjusted EBITDA, not non-GAAP earnings that exclude half the company's expenses. I want to see real cash coming into the business because cash flow is very hard to fake. The second is margin expansion. I want gross margins to be stable or improving and operating margins trending higher over time. That tells me management knows how to control costs and scale profitably. When a company has growing cash flow and expanding margins at the same time, that's a compounding machine. Back to the 5 stocks I own. 3 of these 5 stocks are US companies, and I hold them in US dollars inside my TFSA. All right, let's get into the picks. Stock number 1 is Walmart, ticker WMT. The stock is already up 24% this year, and I still think it's early. Walmart bought Vizio last year, and every Vizio TV they sell becomes an advertising platform. That's a captive audience and high margin ad revenue layered on top of retail. They've also signed a deal to integrate shopping into AI platforms. So when people start asking AI for product recommendations, Walmart is right there capturing that traffic. Add to that their private label brands like Great Value and MarketSide, which are steadily taking shelf space from traditional consumer packaged good companies. Now, look at the fundamentals. Operating cash flow is up 50% over the last 3 years, about 15% annualized, which is exceptional for a grocery-led business. Gross margins are holding steady at 25%, while competitors are getting squeezed by inflation. So I buy this. Stock number 2 is GE Vernova, ticker GEV. The stock is already up 101% last year, but this isn't a momentum story. Everyone talks about AI data centers, but very few people talk about what powers them. You can build a data center in 2 or 3 years, but upgrading grid infrastructure takes 6 to 10 years. Data centers need stable power, transmission, and long-term capacity, and that's exactly GE Vernova's business. Operating cash flow went from negative in 2022 to $3.4 billion over the last 12 months. Even more important, gross margins expanded from 1.5% to 20%. They're not just growing, they're growing profitably. If AI demand keeps rising, the infrastructure company gets paid. So you need to watch this. Stock number 3 is Amazon, ticker AMZN. I know what you're thinking. Everyone owns Amazon. But most investors haven't adjusted their view of what the business is now. Amazon used to be growth at any cost. Margins were thin and cash flow was inconsistent. That era is over. Operating cash flow is up 150% over the last 3 years, about 35% annualized. Operating margins have doubled from 5.3% to 11%. AWS remains dominant. E-commerce market share keeps growing and advertising continues to take share. So I add this to my basket. Stock number 4 is Salesforce, ticker CRM, and this is the contrarian play. The stock is down about 20% as the market worries that AI tools will disrupt software as service companies. Many investors think AI will replace CRM platforms entirely. I disagree. Salesforce is integrating AI directly into its enterprise ecosystem, with Agentforce targeting high-margin recurring revenue. And if you ignore the alternative for a moment and just look at the numbers, operating cash flow doubled from $6 billion to $13 billion, and operating margins expanded from 2% to 22%. So watch this closely. Stock number 5 is Microsoft, ticker MSFT, and this is my highest conviction position. Everyone sees Microsoft as a mature tech giant, but they're missing the infrastructure layer underneath. Azure is growing around 30% year over year, and Microsoft sits at the center of enterprise AI adoption. Free cash flow hit $74 billion last year, and operating margins are around 48%, while everyone else is trying to guess which AI application wins. Microsoft is quietly collecting tolls across the entire ecosystem. Here comes an important part. I'm not buying all 5 stocks at once. I'm spreading purchases over several weeks because early year markets can be volatile. While Microsoft and Walmart pay a small dividend, I prioritize them for their massive capital appreciation potential, with the tax-free gains in a TFSA far outweigh the small 15% withholding tax on their yields. So this is what I'm doing now, for information and sharing purposes only, not financial or investment advice. If this share helps you, hit the like and subscribe button, and if you have any questions or opinions, welcome. Drop a comment below. See you then.